Coinbase's consumer revenue just collapsed 48% in 12 months. Not a bad quarter, a structural collapse. Meanwhile, Morgan Stanley this week described their crypto strategy in 3 words: disintermediating the disintermediators. The intermediaries Bitcoin was built to destroy are now using Bitcoin's own language to announce they're eliminating crypto's middlemen. And the 48% tells you it's already working. I'm Dana Love, PhD, 33 years in this space. I wrote the book on how this capture pattern operates. And once you see the mechanism here, you cannot unsee it. Disintermediation is part of the fabric of modern economic life. Travel agents had information you didn't have: flight schedules, seat availability, pricing. The internet gave you all of that information directly, and the travel agent became structurally unnecessary. Not worse at their job, unnecessary. Video stores had inventory you couldn't access any other way. Streaming gave you that inventory on demand, and video stores disappeared. Blockbuster had $100 million and a brand, and it didn't matter. Record stores. iTunes didn't compete with Sam Goody on price. It made the physical object irrelevant. Every one of these followed the same pattern. A new technology promises to cut out the middleman. It delivers on that promise. And then a larger incumbent used that same technology to cut out the new middleman. Blockbuster didn't beat Netflix, but the banks are doing exactly that to crypto. And they're doing it with crypto's own tools, at crypto's own scale, using crypto's own language. That's what 48% means. On Wednesday, Jed Flynn, Morgan Stanley's head of wealth management, described their crypto strategy to Bloomberg in one sentence. This is much bigger than trading crypto at a cheaper rate. In a way, the strategy is disintermediating the disintermediators. He did not say Morgan Stanley is competing with Coinbase on price. He said Morgan Stanley is eliminating the category that Coinbase represents. There is a difference, and that difference is something you're not hearing from financial reporters. A cheaper competitor takes market share. A disintermediator makes the intermediary structurally unnecessary. Morgan Stanley just dropped an Uno Reverso card on the entire crypto industry, and it seems to be working. 3 things we're covering today. First, what disintermediating the disintermediator actually means as an economic strategy, because the phrase is precise and deliberate, and Finn knew exactly what he was saying. Second, what Coinbase's own numbers tell us about where their consumer business sits in the decay curve. And third, why this is not a competitive threat. It's a Phase 6 event. Let's start with Coinbase's numbers, because the 48% figure is being reported without the context that actually makes it alarming. The financial press has been covering this as a quarter-over-quarter story. Down 23% from Q4 2025. Disappointing, but explainable. Soft market conditions, lower retail activity. That framing obscures what's actually happening. The number that matters is year over year. Q1 2025 to Q1 2026. Same market environment, same seasonal window, 1 year apart. Consumer transaction revenue, $1,095 million in Q1 2025, $567 million in Q1 2026. That is a 48% collapse in 12 months. Total transaction revenue down 40% year over year. Net loss for the quarter of $394 million. That is not a market cycle correction. Bitcoin is up significantly over the same period. If the asset is up and consumer traction revenue is down 48%, something structural is happening to those where those transactions are occurring. Retail investors are not leaving crypto. They are leaving Coinbase. And here is where they are going. Morgan Stanley launched MSBT, the cheapest spot Bitcoin ETF in the United States, at 0.14%, and it surpassed $205 million in assets under management within weeks. They have Ether and Solana ETFs in development. They applied for a national trust bank charter to custody digital assets directly, and now they have launched direct crypto trading on E-Trade at 50 basis points, undercutting Coinbase's retail structure entirely. Fidelity, Charles Schwab, Merrill Lynch, Goldman Sachs, every major wealth management platform in the United States has entered the crypto space. None of them are charging Coinbase-level retail fees. All of them embed crypto execution into the same brokerage accounts their clients already use for equities. Here is the question Coinbase cannot answer. Why would a Merrill Lynch client open a Coinbase account when Merrill Lynch now offers Bitcoin in the account that they already have? The answer is they wouldn't. And they aren't. The 48% collapse is not a warning signal. It's a trailing indicator of a structural shift that has already occurred. Now let me translate Jed Finn's language precisely, because disintermediating the disintermediators is specific economic terminology, and his precision is intentional. Crypto's original pitch to retail was this: you don't need Goldman Sachs. You don't need Morgan Stanley. You can hold your own assets, transact peer-to-peer, and participate in financial markets without paying Wall Street a toll. Coinbase was the bridge that made that accessible. Coinbase was the intermediary that helped you disintermediate Wall Street. What Finn is describing is second-order disintermediation. Morgan Stanley is not arguing with crypto. They launched a Bitcoin product that pulled over $205 million in weeks. They are using crypto to eliminate the companies that used crypto to try to eliminate them. Consider the structural position Morgan Stanley holds that Coinbase cannot replicate. Morgan Stanley manages $9.3 trillion in client assets through roughly 16,000 investment advisors. Those advisors have fiduciary relationships with retirees, working professionals, business owners, people with money who are not going to sign up for a new crypto exchange account. But they will ask their financial advisor whether they should have Bitcoin exposure. And when that advisor says yes, they execute inside the Morgan Stanley platform. Coinbase never sees that transaction. Not because the client chose a competitor, because the client never considered Coinbase at all. Morgan Stanley is rolling E-Trade crypto out to 8.6 million customers. Coinbase's entire active monthly user base is 8.7 million. Morgan Stanley is about to match Coinbase's active retail footprint in a single product rollout. That is distribution capture. That is what Finn means. He is not talking about fee competition. He is talking about making the crypto exchange structurally unnecessary for the households he already serves. Subscribe now. This channel documents the mechanism in real time. The Token Trap is the book that shows you how this pattern has run through every democratizing technology in the last 100 years. There's a link in the description. This has happened before, not approximately, exactly. In my book, I document a 6-phase capture pattern that runs through every democratizing technology, from the internet to social media to crypto. Phase 6 is always the same. The infrastructure owners, the ones with scale, regulatory relationships, and distribution networks, do not fight the technology. They wait. They wait until the technology is proven, until retail capital has built the infrastructure, until the regulatory environment is close enough to legibility that they can participate without existential risk. And then they enter. And when they enter, they do not compete. They capture. What started as ridicule ends in capture. In 2017, Jamie Dimon called Bitcoin a fraud. Morgan Stanley said it was basically worthless. In 2021, Dimon called it a pet rock. The ridicule is functional. It suppresses institutional entry while the asset matures, and it gives rhetorical cover to institutions when they eventually reverse course. They weren't wrong, they'll tell you. The asset finally grew up. Finn said it directly. It's going to be very competitive in the next couple of years, particularly given the regulatory moats are drying up. The regulatory moats. That is what kept them out. Not skepticism, not philosophical opposition to crypto, regulation. The moment regulation cleared, Phase 6 started. Phase 6 is distribution capture. You don't fight the new technology. You become the toll road between that technology and the people who want to use it. Coinbase thought they were the disintermediator. They thought they were the infrastructure phase. They built the exchange, wrote the compliance playbook, trained a generation of retail investors to buy crypto on a centralized platform, and taught every major institution exactly how retail flows work. Morgan Stanley learned from watching Coinbase. Now, Morgan Stanley is doing what Phase 6 actors always do, monetizing the infrastructure someone else built while making that infrastructure operator structurally redundant. Adam Smith predicted this in 1776. The exact quote is in the book and in other videos. But the short version is this. When people in the same trade act on the same interest, it ends badly for the public. He was describing merchants. He could have been describing Morgan Stanley. Nobody coordinated. They just have the same interest. And when enough of them act on the same interest simultaneously, the Coinbases of the world become structurally obsolete. Here's what the financial press is missing in its coverage of the 48% decline. Coinbase is not collapsing. Coinbase has institutional revenue. They have Base, their Layer 2 network, generating real fee income from the on-chain ecosystem. They have reported 13 consecutive quarters of positive adjusted EBITDA. Those lines matter, and they're real. The real question is whether any of that is enough. Because the retail business, the revenue line that just fell 48% year over year, is going to Morgan Stanley's advisors one client at a time. And every client who moves their crypto execution to their existing brokerage account is a client who stops generating revenue for Coinbase. Permanently. Not until prices recover. Permanently. And Morgan Stanley is not on the only front. Coinbase is being pressured on yield products during the Clarity legislative battles. Their stablecoin is being pressured by the manner in which the Genius Act is put to work. Different attacks from different adversaries in different directions. That is the very definition of the barbarians being at the gate. In 2009, the promise was that you could hold your own money, transact without a middleman, and participate in financial markets outside the traditional system. In 2026, the most respected wealth advisors and most respected wealth management firms in the United States, they're offering to hold it for you, eliminate the crypto native intermediary you were using, and plug you back into the same distributed brokerage structure that crypto was designed to route around. The mechanism does not fail. It adapts. Coinbase was never Wall Street's competition. Coinbase was their proof of concept. Jed Flynn just told Bloomberg what comes next. And now I've told you too. Subscribe now. It means a lot to me personally, and it helps with the algorithm. When Coinbase reports next quarter earnings, we'll be here. I'll be giving it to you, giving you all the information. My book, The Token Trap, is on Amazon and at thetokentrap.com. There's a link below. I'm Dana Love. I'll see you in the next one. Ugh, I got too excited there. There was a lot to be excited about. But I'm going to have to do this chapter again.